The New Market Wizards: Conversations with America's Top Traders. By Jack Schwager. The financial markets are a battlefield. For every winner, there are countless casualties. It's a place where 90% of participants are systematically stripped of their capital, their confidence, and their dreams. Yet a select few don't just survive this battlefield, they conquer it. They turn small stakes into fortunes, not once, but consistently, year after year. This isn't luck. It's not magic. It is a skill. And the secret to that skill isn't found in a complex formula or a secret indicator. The secret lies within the mind. Most traders lose because they are playing the wrong game. They think they are battling the market, when in reality, they're battling themselves. They are enslaved by fear, crippled by greed, and blinded by hope. They make decisions based on emotion, not on strategy. They are like a poker player who goes all in on every hand, hoping for a lucky card, while the professional sitting across the table simply waits for the odds to be in their favor. The professional knows the most important opponent isn't the other players. It's the destructive impulses inside their own head. But what if you could dismantle those impulses? What if you could learn to think like a master trader? What if you could install the mental software that separates the 10% who win from the 90% who lose? This is the promise of the journey we are about to embark on. The chronicler of champions. To guide us, we have Jack Schwager. Schwager is not a guru selling a magic system. He is a quiet, meticulous expert, a managing director and principal in the financial world, a man who has spent his career analyzing what works and what doesn't. He gained unprecedented access to the world's most successful and often most secretive traders. He got them to open up, to share not just their strategies, but their stories of catastrophic failure, profound psychological insight, and ultimate triumph. His first book, Market Wizards, became a Wall Street classic, but he knew there was more to the story. In this book, The New Market Wizards, he goes deeper, talking to a new generation of masters who have achieved mind-boggling success. Schwager's work is so respected because he doesn't just report, he decodes. He finds the golden threads, the core principles that connect all these wildly different, fiercely independent champions. In this audiobook summary, we will distill Schwager's incredible work. Together, we will step into the minds of these wizards. We'll journey into the world's biggest market with the Sultan of Currencies, Bill Lipshutz. We'll learn the gritty discipline of a Vietnam veteran turned trader, Randy McKay. We'll dissect the cold, hard logic of a mathematician, William Eckhart, who made a famous bet that great trading couldn't be taught, only to prove himself wrong. And that's just the beginning. This isn't just about trading. This is about mastering psychology, conquering fear, and achieving excellence in any high-stakes endeavor. You will discover not just what these masters did, but how they thought, turning devastating losses into their most valuable lessons and small stakes into empires. Are you ready to learn the secrets of the wizards? The Sultan of Currencies, Bill Lipshutz. Imagine a market so vast it makes the world's stock markets look like a child's lemonade stand. A market where over $1 trillion, that's a million, changes hands every single day. This is the currency market, a 24-hour beast that never sleeps, relentlessly following the sun from New York to Australia, to Tokyo to London, and back again. In this colossal arena, only a handful of players have ever dared to make billion-dollar bets. Bill Lipshutz was one of them. He wasn't just a player. For a time, he was the king, the largest and most successful currency trader for the legendary Wall Street firm, Salomon Brothers. But it didn't start that way, not even close. The story begins not on a chaotic trading floor. but in the quiet halls of Cornell University, where a young Bill Lipshutz was studying to be an architect. He had a plan, a blueprint for his life. Then his grandmother passed away, leaving him an inheritance of $12,000 in a scattered portfolio of about 100 different stocks. For most people, this would be a nice little nest egg. For Lipshutz, it was a seed. He liquidated the portfolio, and with this small amount of risk capital, began to dabble in the stock market. And you'll never guess what happened. The market became an obsession. He found himself spending more and more time not on architectural designs, but on company reports and financial charts. He became, in his own words, a lot more interested in trading. Is this starting to sound familiar? That pull, that fascination with the ultimate puzzle? Now here's the crucial part. He didn't just jump in. He read everything he could. He became an avid student of The Economist, Barron's, and Value Line. He spent hours upon hours just watching the stock tape on cable television, developing a feel for the price action. He was building his mental model, his map of the territory. His big break came when he landed a summer job at Salomon Brothers. It was a baptism by fire. The head of the options desk, a high-strung, fast-talking trader named Sidney Gold, interviewed him with his back to a giant electronic stock tape. After a barrage of questions, Gold abruptly stopped and said, "Okay, forget all this bullshit. You said you're trading your own account. What stocks are you trading?" Lipshutz named a few. Gold finally landed on one he knew, U.S. Steel. U.S. Steel, I know Steel. Where is it trading? He barked. 31.2, Lipshutz replied. It just went across the board at 5.8, Gold shot back. Where did it break out from? 28, Lipshutz answered instantly. And where did it break out from before that? Well, that must have been over 3 years ago. I believe it broke out from about the 18 level. At that moment, Gold stopped looking at the tape, looked Lipshutz straight in the eye, and said, "I want you to work for me." He saw the spark. He saw the passion and the knowledge born not from a classroom, but from obsession. But here's where the story takes a fascinating turn. After his training program, Lipshutz didn't go back to stocks. He was recruited into a brand new department, being formed at Salomon. Foreign exchange. And guess what? He didn't even know what a Deutsche Mark was. No one in the department really knew much about currencies. The firm's idea, in classic Salomon style, was to get a bunch of bright people together, let them figure out how this foreign exchange stuff worked, and see if they could make some money. Think about that for a moment. They were stepping into the world's biggest market with almost zero experience. How could they possibly succeed? The secret, Lipshutz discovered, was that foreign exchange is all about relationships. It's about information flow. He said, if you call up a bank and say, "I need a price on $10 mark," they can tell you, "The mark dealer is in the bathroom, call back later." If I call up and say, "Hey Joe, it's Bill and I need a price on the mark," the response is going to be entirely different. He built those relationships by leveraging what he did know. Options. At the time, currency options were brand new, and the interbank currency traders knew nothing about them. Lipshutz, who had traded stock options, was perceived as a genius. He can derive the Black-Scholes model. He must be a genius, they thought. This gave him access. It got him plugged into the network. But that's not all. He also learned a critical lesson about risk and psychology. Early in his career, he had taken that initial $12,000 inheritance and built it up to an astonishing $250,000. $250,000. He was a success story, and then he lost it all in a few days. The entire account was wiped out. What happened? It was the famous Granville reversal in 1982, the very bottom of a vicious bear market. Lipshutz was heavily bearish and kept pyramiding his position, pressing his bets, convinced he was right. And the market turned on a dime, roaring upwards and obliterating his account. Most people would have been crushed. They would have quit. But what did Lipshutz do? He saw it as one major mistake. He didn't question his ability. Instead, he learned the single most important lesson of his career: risk control. He says, "I probably became more risk control oriented. There are a lot of elements to risk control. Always know exactly where you stand. Don't concentrate too much of your money on one big trade. Always understand the risk-reward of the trade as it now stands, not as it existed when you put the position on." That devastating loss was the tuition fee he paid to learn the most valuable lesson in trading. And it was a lesson he applied to make hundreds of millions of dollars for Salomon Brothers. He learned that a trader's confidence is a vital asset. When you're in a losing streak, he explains, your ability to properly assimilate and analyze information starts to become distorted because of the impairment of the confidence factor. You have to work very hard to restore that confidence, and cutting back trading size helps achieve that goal. Do you see the pattern here? The failure wasn't the end. It was the beginning. It was the catalyst for a deeper understanding. He learned that trading isn't about being right. It's about how much you make when you're right and how little you lose when you're wrong. He learned to detach his ego from the outcome. So when you face a loss, in trading or in life, do you see it as a final judgment on your ability? Or do you see it as tuition? Do you see it as an opportunity to learn the very lesson you need to reach the next level? That shift in perspective is the first secret of the wizards. The veteran's mindset, Randy McKay. Now let's shift from the high-tech global world of currency trading to the raw, visceral environment of the Chicago futures pits. Let's talk about a man whose trading education didn't come from a university, but from the jungles of Vietnam. Randy McKay is one of a rare breed. A trader who started with just a few $1,000s and turned it into a fortune. And more importantly, kept it for over 20 years of consistent profitability. His story is a powerful lesson in how real-world discipline, the kind forged in life or death situations, can be the ultimate trading advantage. In his second year of college, McKay became addicted to bridge, flunked out of school, and was immediately drafted by the Marines. In 1968, it was the height of the Vietnam War. "I went from being a rule follower to thinking for myself," he says. "When I realized that the leaders in the country didn't necessarily know what they were doing, I became much more independent." Does that sound like a valuable trait for a trader? The ability to think independently and not blindly follow the crowd? After returning from Vietnam, his brother, a floor broker, got him a job as a runner on the floor of the Chicago Mercantile Exchange. It was supposed to be a temporary job while he studied to become a clinical psychologist. But something fascinated him. "I realized that prices moved based on the psychology of the people who were trading," he recalls. "You could actually see anxiety, greed, and fear in the markets." He got his chance to trade when the exchange launched currency futures. His brother gave him the use of a seat and a $5,000 loan. McKay put $3,000 in the bank for living expenses and started with a tiny $2,000 trading account. In his very first 7 months, he made $70,000. An unbelievable return. But the story isn't about one lucky streak. It's about a core philosophy that he developed. A philosophy that you can use. So how did he do it? What was his secret? It wasn't about complex charts or economic forecasts. It was simpler and far more profound. "I watched the market action, using fundamentals as a backdrop," he explains. But here's the twist. I don't use fundamentals in the conventional sense. Rather, I watch how the market responds to fundamental information. This is a game-changing concept. Think about it. Most people hear good news and they buy. They hear bad news and they sell. McKay does the opposite. He observes. If a market should go down on bearish news, but it doesn't, what does that tell you? It tells you there is tremendous underlying strength. The market is absorbing the bad news and holding firm. It's like a boxer taking a punch and not even flinching. That is a sign of incredible power. He gives a perfect example. On the eve of the US air war against Iraq, gold was trading near the crucial $400 level. The night our planes started the attack, gold went from $397 to $410 and closed the evening at about $390. Thus, gold had broken through the critical $400 level, starting the rally that everyone expected. But it finished the evening significantly lower, despite the fact that the United States had just entered the war. The next morning, the market opened very sharply lower. The market had failed to respond to bullish news. That was the only signal he needed. It was a sign of profound weakness. But it wasn't just about reading the market's psychology. It was about his own. McKay developed an ironclad rule that is perhaps the most important piece of advice in this entire book summary. When I get hurt in the market, I get the hell out. It doesn't matter at all where the market is trading. I just get out. Because I believe that once you're hurt in the market, your decisions are going to be far less objective than they are when you're doing well. If you stick around when the market is severely against you, sooner or later, they're going to carry you out. He's not just talking about limiting financial loss. He's talking about preserving his psychological capital. He knows that a bad loss clouds your judgment. It makes you want to get it back. It leads to revenge trading, which is a guaranteed path to ruin. By getting out immediately, he wipes the slate clean. He lives to fight another day with a clear head. And what about winning? He has a philosophy for that too. I never try to buy a bottom or sell a top, he says. I want to catch the easy part. The easy part, he explains, is the middle of the move. He lets someone else take the risk of figuring out the exact turning point. He waits until the move is underway, until the trend is confirmed, and then he jumps on board. This removes so much of the stress and guesswork that plagues most traders. Do you see the wisdom in this? It's not about ego. It's not about being the hero who calls the exact top or bottom. It's about consistently making money. He gives up the first part of the move and the last part of the move. But he captures the powerful, profitable middle. Randy McKay's story teaches us that true discipline isn't about forcing yourself to follow 100 complicated rules. It's about understanding a few core principles of market psychology, and most importantly, your own psychology. It's about knowing when to act and when to get the hell out. The mathematician's paradox, William Eckhart. We now arrive at one of the most legendary stories in modern finance. It's a story that centers on a simple but profound question. Are great traders born, or are they made? Can trading excellence be taught like a subject in school? Or is it an innate talent, a kind of rare genius? On one side of this debate was Richard Dennis, a trading legend who had turned a few $100s into a reported $200 million. He believed trading was a set of rules that could be taught to anyone. On the other side was his partner, William Eckhart, a brilliant mathematician who was on the verge of getting his PhD in mathematical logic. Eckhart believed trading was an art, a skill that couldn't simply be transferred through instruction. To settle their argument, they conducted an experiment. They placed an ad in the Wall Street Journal seeking people to be trained as traders. They selected a small group of individuals from over 1,000 applicants, people from all walks of life. They taught them their systems, their rules, gave them millions of dollars of their own money to trade, and sent them off. This group became famously known as the Turtles. And the results were so staggering, they changed Wall Street forever. But what about Eckhart Darnay, the man who argued it couldn't be done? His story is a fascinating journey into the mind of a systematic, logical thinker, confronting a world, the market, that defies simple logic. Eckhart came to trading from the world of academia. He thought he could apply the analytical techniques of a mathematician to the markets in a straightforward way. I was wrong about that, he admits. What he discovered is something that trips up countless smart people who try to trade. He discovered that the market isn't a clean logical system. It's what he calls pathological. What does he mean by that? He means that price movements don't follow the neat normal distribution or bell curve that statisticians love. In the real world of markets, extreme events, crashes, and manias happen far more often than conventional statistics would predict. Lurking somewhere out there, he warns, are more extreme scenarios than you might imagine. The 1987 stock market crash, a 22 standard deviation event that should happen only once in the history of the universe, was a perfect example. If you rely on traditional risk models, you will be wiped out. This led him to a core belief. In trading, you need blunt statistical instruments, robust techniques. You need methods that can withstand the chaotic, unpredictable nature of the market. We've journeyed through the minds of a currency king, a disciplined veteran, and a skeptical mathematician. We've learned that a devastating loss can be the greatest lesson. That the market's reaction to news is more important than the news itself. And that our own instincts are often our worst enemy. But the journey is far from over. Now we turn to a different kind of wizardry. Not the kind of grand macroeconomic bets, but the art of finding explosive growth where no one else is looking. The art of finding. The rocket ship. Richard Driehaus. Imagine being 13 years old. While other kids are spending their money from a paper route on candy or comic books, you're investing it in the stock market. This was Richard Driehaus. And, from that early age, he learned a fundamental lesson that would make him a Wall Street legend. Following the crowd is a recipe for mediocrity. My early investments, which were guided by financial columnist and broker, recommendations fared poorly, he recalls. I had thought that if I followed the advice of professionals, I would make money. I found the experience very disheartening. This early failure didn't scare him away. It ignited a quest. He decided to figure out for himself what really made stock prices move. And he discovered a simple, powerful truth. He found a newsletter called America's Fastest Growing Companies, and it changed his life. Why? It showed me the success that could be achieved by buying growth stocks, he says. Harold had stocks in his newsletter that he had recommended 10 years earlier that were up 10-fold and 20-fold. It seemed logical that if a company's earnings were growing over a long period of time, its stock price had to go in the same direction. This became his core philosophy. Price follows earnings growth. Everything else is secondary. While other investors were hunting for bargains in beaten-down, low-priced stocks, Driehaus was hunting for rocket ships. He was looking for companies with accelerating revenues and earnings. Companies that were leaders in innovative, expanding markets. And this led him to a strategy that is completely counterintuitive to most investors. Are you ready for this? He actively seeks out stocks with high price-to-earnings ratios. Stocks that are making new highs. Stocks that other people think are too expensive. Think about the conventional wisdom. What does everyone say? Buy low, sell high. Driehaus takes exception to this. I believe that far more money is made buying high and selling at even higher prices, he states. That means buying stocks that have already had good moves and have high relative strength. That is, stocks in demand by other investors. I would much rather invest in a stock that's increasing in price and take the risk that it may begin to decline than invest in a stock that's already in a decline and try to guess when it will turn around. This is a profound mental shift. Most people are afraid to buy a stock that has already gone up a lot. It feels uncomfortable. It feels like you've missed the boat. Driehaus understands that a stock making new highs is a sign of strength, not a warning sign. It's a sign that the company is doing something right, that its story is powerful, and that other investors are recognizing it. Let's look at one of his biggest winners, Home Shopping Network. In 1986, this was a brand new concept, selling merchandise over cable television. In its first 6 months, the company had sold $64 million in merchandise and earned $7 million. The numbers were staggering. The stock went public at $18 a share, and its first trade was in the low 40s. Most people would say, it's up too much, I've missed it. What did Driehaus do? He bought most of his position between the low 40s and low 50s. Why wasn't he scared? No, because the growth was tremendous. The company was making lots of money, and the potential at the time seemed open-ended. And the result? Within 5 months, the stock was at $100. By early 1987, it had reached $200. He bought high and sold much, much higher. But here's the other side of the coin, and it's just as important. How did he know when to get out? He didn't wait for the earnings to collapse. He listened for a subtle shift in the story. At an investor meeting, management admitted that almost all the growth was coming from new subscribers, not from existing ones. At the same time, the stock started to break down technically on the charts. That was all I needed, Driehaus says. I sold the stock aggressively and eliminated my entire position over the next few weeks. He didn't wait for proof of disaster. He sold on the first sign of a crack in the fundamental story. His approach is a beautiful blend of deep, fundamental research and disciplined technical timing. He uses fundamentals to find the what, the companies with explosive growth potential. He uses technicals to determine the when, the right time to buy, and crucially, the right time to sell. I won't buy a stock when it's dropping, even if I like the fundamentals, he insists. I have to see some stability in the price action before I buy. And what about cutting losses? We probably have more losers than winners, he admits, but we cut our losses. He doesn't let a mistake turn into a catastrophe. The Driehaus method is a masterclass in swimming against the tide of conventional wisdom. It teaches us to stop looking for what's cheap and start looking for what's great. It teaches us that a high price can be a sign of quality, not overvaluation. And it reminds us that to achieve extraordinary returns, you have to be willing to do what feels uncomfortable. You have to be willing to buy the stock that everyone else thinks is too high, and have the discipline to sell it the moment its beautiful story starts to change. The master of consistency, Gil Blake. What if I told you there was a trader who was profitable in 96% of the months he traded? A trader who once had a winning streak of 65 consecutive months without a single loss. It sounds impossible, like something out of a financial fairy tale, but it's the real-life track record of Gil Blake. His story is not about hitting grand slam home runs. It's about the relentless, methodical pursuit of a small, consistent edge, repeated over and over until it compounds into a fortune. He is the master of consistency. And how did this master get his start? Not on Wall Street, but in a quiet office where a friend showed him a peculiar pattern in municipal bond funds. His friend noticed that the price of the fund had declined for 22 consecutive days. "Why couldn't I just switch out of the fund into cash when it started to go down?" his friend asked, "and then switch back when it started to go back up?" Blake's initial reaction was pure skepticism. He was a graduate of the Wharton Business School. He had been taught the random walk theory, the academic idea that market movements are random and cannot be predicted. "I don't think the markets work that way," he told his friend. "Get some more data, and I bet that you'll find this is not something you could make any money on." What do you think happened? His friend got more data, and the pattern held up. The persistency of the daily trends was undeniable. Blake, to his credit, didn't cling to his academic theories. He saw the evidence, and it changed his life. "I quickly became convinced that there was definitely something non-random about the behavior of municipal bond funds," he says. This is the first critical lesson from Gil Blake, the power of an open mind. He was willing to discard a deeply held belief when confronted with contradictory evidence. How many of us are willing to do that? He discovered a simple but powerful rule. In the bond fund data, any uptick or downtick day had an approximately 83% probability of being followed by a move in the same direction. And because the fund company, Fidelity, allowed switching in and out of the fund at no charge, he could exploit this inefficiency. While the bond market was collapsing, the fund's value dropped by nearly 50% from 1980 to the end of 1981. Blake, by simply stepping aside during the downtrends, was making gains of over 20% per year, plus another 10% in interest. The odds were so favorable that he took out 4 successive second mortgages on his house to increase his trading capital. But what happens when the edge disappears? This is a test that every great trader faces. As more people discovered this inefficiency, the pattern in bond funds began to fade. The reliability dropped and the volatility shrank. The potential return fell. What did Blake do? Did he cling to his old method? No, he adapted. He went back to the library, back to the microfilm machine, and started a new hunt. He was looking for another needle in the haystack, and he found it. He discovered something even better in Fidelity's sector funds. Funds that focused on specific industries like technology, gold, or healthcare. What did he find? He found that the more homogeneous a group of stocks was, the more persistent its trend was. He explains it with a beautiful analogy. Assume you have a stack of coins, and each has a 55% chance of landing on heads. If you toss a single coin, the odds are 55%. If you toss 9 coins, the odds of getting more heads than tails go up to 62%. And if you toss 99 coins, the odds go up to about 75%. Similarly, assume you have 99 chemical stocks. While the odds of a single chemical stock being up tomorrow may be 55%, the odds for the entire chemical group are much closer to 75%. This was his breakthrough. By focusing on narrow, specialized sectors, he could find trends with a 70–80% probability of continuing for another day. And these sectors were far more volatile than the bond funds, offering more than 5 times the profit potential. He had found a bigger, sharper edge. But the final piece of the puzzle was his own psychology. How did he achieve such incredible consistency? By mastering his emotions. My approach, he says, is to confront losses even before they materialize. I rehearse the process of losing. Whenever I take a position, I like to imagine what it would be like under the worst-case scenario. In doing so, I minimize the confusion if that situation actually develops. This is a powerful mental technique. By visualizing the worst case, he desensitizes himself to it. The loss, when it comes, is no longer a shock. It's a pre-rehearsed scenario for which he already has a plan. He embraces the loss. By embracing a loss, really feeling it, I tend to have less fear about a potential loss the next time around. He explains. If I can't get over the emotions of taking a loss in 24 hours, then I'm trading too large or doing something else wrong. Gil Blake's story isn't about being a genius who can predict the future. It's about a meticulous researcher who finds a statistical edge. It's about having the open-mindedness to see that edge, the adaptability to find new ones when the old ones fade, and the psychological discipline to execute your strategy flawlessly, day in and day out. His success is a testament to the idea that you don't need to be a high-flying risk-taker to win. You just need an edge and the serenity to apply it. The Art of Top-Down Investing. Stanley Druckenmiller. We've met wizards who find their edge in the microscopic details of a single company or a statistical pattern. Now, we meet a wizard who operates from 30,000 feet, a master of the big picture. Stanley Druckenmiller belongs to the rarefied world of managers who control multi-billion-dollar portfolios. And he doesn't just manage them, he makes them dance. Achieving returns that would be impressive on a small account, but on a fund of billions are simply staggering. For 3 years, he took the helm of the legendary Quantum Fund from his mentor, George Soros, and generated an average annual return of over 38%. Druckenmiller's style is the polar opposite of a specialist like Driehaus. He is a top-down investor. He starts with a grand macroeconomic view of the world, interest rates, currency flows, political shifts, and then drills down to find the best way to express that view. That might mean buying stocks, shorting bonds, or taking a massive position in a currency. His genius lies in his flexibility and his courage to bet big when he has conviction. His story is a powerful lesson in a different kind of wisdom. How to synthesize vast amounts of information into a single, coherent trade, and how to have the nerve to act on it. One of his most defining moments came in the lead-up to the October 1987 stock market crash. By June of that year, he had already turned bearish. Why? He saw the big picture. Valuations had gotten extremely overdone, he recalls. Also, the Fed had been tightening for a period of time. Finally, my technical analysis showed that the breadth wasn't there. The market's strength was primarily concentrated in the high capitalization stocks. But here's a key insight into his timing. I never use valuation to time the market, he stresses. I use liquidity considerations and technical analysis for timing. Valuation only tells me how far the market can go once a catalyst enters the picture. The catalyst for him is always liquidity, the flow of money. And in 1987, the Fed was turning off the tap. He was fighting the market for months, holding a short position while prices crept higher. This takes immense psychological fortitude. But he had a philosophy, one he learned from George Soros. When you earn the right to be aggressive, you should be aggressive. Since I was well ahead for the year, I felt that I could afford to fight the market for a while. By October 16th, the Friday before the crash, the market had started to break. He had made back all his losses and was having a very profitable year. And then he made what he calls one of the most tragic mistakes of my entire trading career. He went from being net short to 130% long. He bet the farm on a market bounce, right on the eve of the biggest crash in modern history. What happened next is a masterclass in psychological recovery. That very weekend, he realized his mistake. A study by another wizard, Paul Tudor Jones, and a conversation with the legendary Jack Driehaus convinced him he was on the wrong side of history. I was sick to my stomach when I went home that evening, he says. I realized that I had blown it and that the market was about to crash. Most traders would be paralyzed. They would hope, they would pray, they would freeze. What did Druckenmiller do? He made a plan. When the market opened down over 200 points on Monday morning, he didn't hesitate. I knew I had to get out, he said. Fortunately, there was a brief bounce shortly after the opening, and I was able to sell my entire long position and actually go net short. Think about that. He took a massive loss on his long position, reversed his entire stance in the middle of a historic panic, and ended the month with a net gain. This is the mark of a true wizard. The ability to be brutally honest with yourself, to admit a mistake instantly, and to act decisively without being crippled by your ego. He learned another powerful lesson from Soros. It's not whether you're right or wrong that's important, he says, but how much money you make when you're right and how much you lose when you're wrong. Soros taught him that when you have true conviction, you have to go for the jugular. He tells a story. Shortly after joining Soros, he was bearish on the dollar and put on a large short position. He was proud of himself. Soros came into his office. "How big a position do you have?" Soros asked. $1 billion, Druckenmiller answered. "You call that a position?" Soros said dismissively. Soros encouraged him to double the position. He did, and the trade became a massive winner. Soros has taught me that when you have tremendous conviction on a trade, you have to go for the jugular. Druckenmiller says, "It takes courage to be a pig." Stanley Druckenmiller's approach teaches us that success can come from seeing the forest, not just the trees. It's about understanding the great tides of liquidity that move all markets. But more than that, it's about having the internal fortitude to act on your convictions with immense size, and the even greater courage to admit when you are catastrophically wrong and reverse course on a dime. It's the art of combining intellectual horsepower with psychological steel. We have explored the minds of wizards who masterfully ride the great global trends and those who meticulously hunt for hidden gems. We've seen the power of statistical edges and the wisdom of contrarian thinking. Now, we venture into a different realm altogether. The world of the money machines. These are not traders in the traditional sense. They are not betting on market direction. They are brilliant mathematicians and strategists who have built firms that systematically extract small, consistent profits from the market's temporary inefficiencies. They are the architects of trading systems so complex and so fast that they operate on a different plane. The Blackjack connection, Blair Hull. The journey of Blair Hull, a trading pioneer, didn't begin on Wall Street. It began at the blackjack tables of Nevada. And this is not as strange as it sounds, because Hull understood something profound. Consistent winning, whether in cards or in markets, is not about luck. It's about strategy, discipline, and money management. After reading Ed Thorp's classic book, Beat the Dealer, Hull realized that the game of blackjack, long thought to be a game of pure chance, had a hidden flaw. By counting the cards, a skilled player could identify moments when the odds shifted, ever so slightly, from the house to the player. For Hull, this was a revelation. It was a quantifiable edge. Whether you're playing blackjack or trading, he explains, your profitability depends on your edge and how many times you get to apply that edge. At first, he played solo, betting small amounts only when the deck was rich in high cards. But the real breakthrough came when he joined a team of professional card counters. Why a team? For two reasons that are directly parallel to sophisticated trading. First, the law of large numbers. Assume that over a weekend of playing, he says, The odds of my coming out ahead are 2 out of 3. By combining banks with another person, the probability of winning would rise to 3 out of 4. The more players you combine, the better your chances of a successful outcome. By pooling their capital and increasing the number of bets, they turned a probability into a near certainty. Second, money management. The team approach allowed them to increase their bet size while managing their risk. Theoretically, he says, the largest bet you can make should be 1/50th of your capital. If you have $1,000, that means your biggest bet should be $20. If 5 players with $1,000 apiece combine, however, the maximum bet size increases to $100. This allowed them to maximize their profits during the brief windows when they had an edge. But what does this have to do with trading? The experience of going through extensive losing periods and having the faith to stick with the system. Because I knew that I had the edge was something that helped me a great deal when I went into the pit, Hull says. He learned the gut-wrenching reality of drawdowns. He learned that even with a winning strategy, you will have painful losing streaks. And he learned the discipline to cut his bet size when he was losing to ensure he could stay in the game. If you lose half your stake, he explains, you have to cut your bet size in half. That's a difficult thing to do when you're down significantly, but it's essential to surviving. When the casinos eventually caught on and barred his team, Hull sought a new arena to apply these principles. He found it in the newly listed world of stock options. In 1976, with a starting stake of $25,000 earned from Blackjack, he became a market maker. His method was a direct translation of his card-counting strategy. He wasn't trying to predict if a stock would go up or down. He was looking for mispricings. Using a computer model he developed, remarkably similar to the famous Black Scholes model, which he hadn't yet read, he would generate theoretical value sheets for options. Then, on the trading floor, he would simply buy options that were trading below their theoretical value and sell options that were trading above it. But here's the key insight. He wasn't just comparing the option's price to the model. He was looking at relative value. It doesn't matter what model you use, he says, as long as you apply it consistently across all option prices. I would adjust the model implied prices so that the at-the-money implied price was in line with the market price. Then I would merely buy those options that were trading cheaper and sell those that were more expensive. He was arbitraging the inefficiencies between different options on the same stock. He also discovered the same pathological reality that William Eckhart did, that real-world markets have fatter tails than the models predict. Extreme moves happen more often than they should. This meant that selling deep out-of-the-money options, a strategy that yields small, consistent profits, was a ticking time bomb, and it blew up on him. In 1981, 2 surprise takeovers on positions where he had sold out-of-the-money calls wiped out nearly half of his cumulative profits. It was another painful lesson, but a vital one. It taught him the hidden risks in seemingly safe strategies. Blair Hull's story is a bridge between the world of gambling and the world of professional trading. It shows that the course prayer board als bar Danos Thor and the part or the article. First, find a quantifiable edge. Second, apply a rigid money management system to ensure you can survive the inevitable losing streaks. Third, have the psychological discipline to execute your strategy without emotion. Over and over again. As Hull puts it, all you need is a mathematical advantage and the money management controls to assure that you stay in the game. Everything else takes care of itself. The mathematics of strategy, Jeff Yass. If Blair Hull built the bridge from blackjack to options, Jeff Yass paved it with the complex mathematics of poker theory. Yass, the co-founder of the Susquehanna Investment Group, one of the largest option trading firms in the world, sees the market as the ultimate poker game. His approach is a masterclass in strategic thinking, where every trade is a calculated bet, based not just on the cards, but on the other players at the table. I learned more about option trading strategy by playing poker than I did in all my college economics courses combined, he says. Why? Because poker teaches you a crucial lesson that most traders never learn. The goal is not to win the most hands. It is to maximize your total winnings. He gives a classic example. Assume that you're certain that you have the best hand and the last card has just been dealt. What do? A novice trader would say, I would bet the limit. However, that is often not the right move. Why? Because sometimes when you pass, he'll bet, giving you the opportunity to raise, in which case you'll win double the bet size. It's about playing for the biggest possible pot, even if it means sometimes winning nothing on a sure thing. How does this apply to options? Let's say you have the opportunity to buy 100 calls of an option you believe is worth 314 at 3, giving you an expected $2,500 profit, he explains. Most market makers would say that you just buy the option at 3. However, if you estimate that there is a 60% probability of being able to buy the same option at 234, your best strategy would be to try to buy at 234, even though doing so means that 40% of the time you're going to miss the trade entirely. Over the long run, this patient, strategic approach yields a higher average profit. But Yass's most powerful insight is about what he calls conditional probability. He learned that you can't just trade based on your own opinion of an option's value. You have to constantly update that opinion based on what other people are doing. He gives another poker analogy. Assume you're playing 7-card stud. You have 3 cards in the hole and 4 aces showing. Your opponent has junk showing. The question we ask is, what do you make when Surger? The typical response is, I would bet as much as I can because I have 4 aces. The correct answer is, you pass. Why? Because your opponent knows exactly what you have. He will only call or raise if he can beat you. You have nothing to gain by betting and everything to lose. The trading analogy? Let's say that I believe an option is worth $3, Yass says. However, let's say a broker, whom I suspect has superior information, asks me for a quote. I have nothing to gain by making a tight market, because if I price the option right, he'll pass. And if I price it wrong, he'll trade and I'll lose. The very fact that a smart player wants to do a trade with you is new information. It's a signal that your own valuation might be wrong. This is a profoundly humble approach. Yass says, it's my firm belief that the market's wisdom is far greater than mine. The odd thing about believing in efficient markets is that you have to surrender your beliefs and ego to the markets. He has a tremendous respect for the collective intelligence of the market. When a knowledgeable trader is bidding for an option at a price that seems too high, Yass's first assumption isn't, that guy is an idiot. It's, he probably knows something I don't. His team then tries to figure out why that option is being bid up. This strategic thinking protects him and his firm from being picked off by traders with inside information. He knows that unusual activity in the options market often precedes a big news event like a takeover. Jeff Yass teaches us that trading at the highest level isn't just about having a better model. It's about playing a better game. It's about understanding that the market is not an abstract system, but a dynamic arena full of other players with their own information and motives. It's about having the strategic foresight to know when to bet, when to pass, and when to fold. And it's about having the humility to listen to what the market is telling you, even when it contradicts your own brilliant analysis. The role of the subconscious, Robert Krausz. We have now reached the deepest level of our journey. We've talked about strategies, systems, and psychology. But what if there's an even more powerful force at play? A hidden director shaping our decisions without our conscious knowledge. We now turn to Robert Krausz, a trader, hypnotherapist, and a man with a truly extraordinary life story to explore the role of the subconscious mind. Krausz's journey is one of incredible survival and transformation. A childhood spent in a Hungarian ghetto during World War II, an escape from a death camp march, years in orphanages, and finally, adoption by a wealthy South African diamond magnate. His life path led him to be a paratrooper in the Israeli army, a successful dress designer in London, and finally, a full-time trader. His entry into trading was a disaster. Lured by the 1979 gold boom, he made the classic beginner's mistake. His first few trades were winners. The greatest tragedy happened, he says. My first trade was an absolute winner. This early success gave him a false sense of confidence. He then proceeded to lose it all, and more, when the market turned. It was a painful blow, not just financially, but to his ego. This failure led him on a quest to understand the markets, but he found he was paralyzed by fear. The fear of loss had arrived, he recalls. This is a feeling almost every trader knows. The memory of past pain creates hesitation and self-sabotage. It was this freeze antipor intersit, as he calls it, that led him to hypnotherapy. What he discovered changed his perception of reality. I realized that the subconscious mind had the power to overcome the conscious mind, he says. He learned that to succeed, the conscious and subconscious minds must be in harmony. And the key to that harmony is a single, powerful belief. To keep your winnings, he insists, your subconscious mind must believe only one thing, that you deserve your winnings. Is the absence of this belief the reason people lose? Yes, 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 he exclaims. He tells the story of a highly successful 30-year veteran who suddenly started losing hundreds of thousands of dollars a month. The losing streak began right after his much younger wife left him. Through hypnosis, Krausz uncovered the root cause. He believed that the breakup of his marriage was due to his inability to perform sexually. Because at the subconscious level, he felt that he had failed his wife. He was punishing himself by losing in the markets. He felt he didn't deserve to win anymore. Once Krausz helped him reframe this belief, his trading immediately turned around. This reveals a startling truth. Sometimes our reasons for failure in the market have nothing to do with the market itself. They are projections of unresolved conflicts in other areas of our lives. The market becomes an arena for self-punishment. Krausz is clear. Hypnosis is not a magic wand. If you don't have a methodology and trading plan, all the hypnosis in the world won't help you. You must do the work first, develop a method, test it, and create a plan. But even with a great plan, a trader can fail. Why? Every time you have a losing trading plan, the memory is etched in your subconscious, he explains. The more losses, the deeper the impression and the deeper the pain. The losses from your previous methodology are so ingrained in your subconscious that whenever you contemplate making a trade, the adrenaline starts to flow, and the fear of executing a trade arises. The solution is to bypass the critical, conscious mind and communicate directly with the subconscious. Through deep relaxation and visualization, a trader can erase the previous pictures of impending financial disaster and paint new pictures in beautiful colors, showing a happy, confident, and successful trader. Robert Krausz's work pulls back the final curtain. It shows us that beneath our carefully constructed strategies and disciplined rules, there is a deep, powerful subconscious mind that is often running the show. And until we align that powerful force with our conscious goals, until we truly believe on the deepest level that we deserve success, we may be destined to sabotage our own best efforts. The final frontier of trading is not the market. It is the uncharted territory of our own minds.